Welcome to your 40s. This decade can be a financial turning point. But did you know that nearly 40% of Americans can't cover a $400 emergency expense? Shocking, right? Even more surprising, the average American carries over $38,000 in debt, excluding mortgages. In this video, we'll expose the hidden wealth traps lurking in your 40s. These traps can derail your financial future if you're not careful. We'll cover sneaky debt spirals, investment scams, and the pitfalls of lifestyle inflation. Plus, we'll share strategies to protect your retirement, avoid hidden fees, and ensure your job security isn't an illusion. You'll also learn about the dangers of overleveraging in real estate, the risks tied to pension plans, and the allure of get-rich-quick schemes. Each chapter is packed with tips and real-life examples to keep your money safe and growing. Stay with us as we dive into the common traps and, more importantly, how to avoid them. Your financial future depends on it. 1. The sneaky debt spiral. Debt can sneak up on you. Many people in their 40s find themselves in a debt spiral, often without realizing it. Did you know that the average American carries about $38,000 in personal debt, excluding mortgages? That's a lot of money. The first step to escaping this trap is awareness. List all your debts. This includes credit cards, loans, and any other obligations. Once you have a clear picture, prioritize paying off high-interest debt first. Credit cards often have the highest rates. For example, if you have a credit card with a 20% interest rate, paying it off can save you a ton in interest over time. A great strategy is the Snowball Method. Pay off the smallest debt first, then move to the next smallest. It's like rolling a snowball down a hill. It gains momentum as it goes. Another key is avoiding new debt. It sounds simple, but it's crucial. If you keep adding to your debt, you'll never get out. Cut unnecessary expenses. Do you really need that subscription service? Or those daily lattes? Small cuts add up. Consider consolidating your debt. This can simplify payments and potentially lower your interest rate. But be cautious. Make sure you're not extending the life of your debt and paying more in the long run. Remember, the goal is to get out of debt, not just move it around. 2. Investment Mirage, too good to be true. Investing is a great way to build wealth, but beware of scams. Many people are lured by promises of high returns with low risk. Remember the Bernie Madoff scandal? It's a prime example. Madoff's Ponzi scheme cost investors an estimated $65 billion. That's billion with a B. A good rule of thumb: if it sounds too good to be true, it probably is. Legitimate investments typically offer moderate returns. For example, the stock market averages about 7% per year over the long term. If someone promises you 20% or more with no risk, run the other way. Do your homework before investing. Check the credentials of the person offering the investment. Are they registered with the SEC? Have they been involved in any scandals? A quick online search can reveal a lot. Diversify your investments. Don't put all your eggs in one basket. Spread your money across different types of investments. Stocks, bonds, and real estate are good options. This way, if one investment fails, you don't lose everything. Consider consulting a financial advisor. A good advisor can help you navigate the investment landscape and avoid scams. Look for someone with a fiduciary duty, meaning they are legally required to act in your best interest. 3. The lifestyle inflation trap. Lifestyle inflation is a sneaky wealth trap. As your income increases, so do your expenses. Suddenly, you're spending more on things you don't really need. It's easy to fall into this trap in your 40s, especially if you're earning more than ever before. The key to avoiding lifestyle inflation is living below your means. Just because you can afford something doesn't mean you should buy it. Focus on saving and investing your extra income. This will pay off in the long run. Create a budget and stick to it. Track your spending and see where your money is going. You might be surprised at how much you're spending on non-essentials. Cut back where you can and put that money into savings or investments. Set financial goals. Having clear goals can help you stay focused and avoid unnecessary spending. Whether it's saving for retirement, a vacation, or a new home, having a goal gives you something to work towards. Remember, it's not about depriving yourself. It's about making smart choices. Do you really need that luxury car, or would a reliable, less expensive car do the job? The difference in cost can go a long way towards securing your financial future. 4. Retirement robbers avoiding deceptive schemes. Retirement is a prime target for scammers. Many people in their 40s start to think seriously about retirement, making them vulnerable to fraudulent schemes. According to the FBI, Americans lose more than $3 billion to financial scams each year. To protect your retirement savings, stay vigilant and informed. First, be cautious with unsolicited offers. If someone contacts you out of the blue with a great investment opportunity, it's a red flag. Scammers often use high-pressure tactics to get you to act quickly. Take your time to research any offer thoroughly. Verify the legitimacy of any financial advisor. Check their credentials and look for any disciplinary actions. The Financial Industry Regulatory Authority, FINRA, offers a free tool called BrokerCheck, where you can review the history of financial professionals. Understand the investment products you're considering. Avoid complex investments you don't understand. Scammers often use complicated jargon to confuse their victims. A simple, transparent investment is usually safer. Keep an eye on your accounts. Regularly review your bank and investment statements. If you notice any unauthorized transactions, report them immediately. It's also wise to use secure, unique passwords for your financial accounts and change them regularly. Consider working with a fiduciary advisor. Unlike other financial advisors, fiduciaries are legally obligated to act in your best interest. This can provide an extra layer of protection against potential scams. 5. Hidden fees and silent wealth drains. Hidden fees can silently drain your wealth over time. Many people don't realize how much they're paying in fees, which can add up significantly. According to a study by the Center for Retirement Research, the average 401k plan charges fees that reduce balances by 27% over a lifetime. Start by reviewing your investment accounts. Look for expense ratios, management fees, and trading costs. Even a 1% difference in fees can have a big impact over time. For example, if you have $100,000 invested over 30 years, a 1% fee could cost you more than $76,000 in lost returns. Switch to low-cost index funds or ETFs. These funds often have lower fees compared to actively managed funds. Vanguard and Fidelity offer many low-cost options that can help you keep more of your money. Examine your bank accounts for hidden fees. Some banks charge monthly maintenance fees, overdraft fees, and ATM fees. Consider switching to a bank that offers fee-free accounts. Online banks often have lower fees than traditional brick-and-mortar banks. Monitor your credit card statements. Credit card companies may charge annual fees, late payment fees, and foreign transaction fees. Look for cards with no annual fee and low interest rates. Paying off your balance in full each month can also help you avoid costly interest charges. Negotiate lower fees. Don't be afraid to ask for a reduction in fees from your financial advisor or service providers. Many companies are willing to negotiate to keep your business. 6. The false security of stable jobs. Relying solely on a stable job can be a financial trap. Jobs that seem secure can disappear overnight. A survey by the Bureau of Labor Statistics found that the average worker stays with their employer for about 4.2 years. That's not as long as you might think. Diversifying your income streams is essential. Start a side hustle or invest in passive income sources like rental properties or dividend-paying stocks. This can provide a financial cushion if you lose your job. Build an emergency fund. Aim to save 3 to 6 months' worth of living expenses. This fund can cover your costs while you look for a new job or start a business. Keep this money in a high-yield savings account, where it's easily accessible. Invest in your skills. Continuous learning can make you more valuable in the job market. Take courses, attend workshops, and earn certifications in your field. The more skills you have, the more opportunities you'll find. Network regularly. Keep in touch with former colleagues and attend industry events. A strong professional network can help you find new job opportunities if needed. LinkedIn is a great tool for maintaining and expanding your network. Consider career flexibility. Look for jobs that offer remote work options or flexible schedules. This can make it easier to manage multiple income streams and reduce reliance on a single job. 7. Overleveraging real estate, the property pitfall. Real estate can be a great investment, but overleveraging can lead to financial trouble. Overleveraging means taking on too much debt to finance property purchases. During the 2008 financial crisis, many learned this lesson the hard way. According to the Federal Reserve, Household real estate debt peaked at $10.6 trillion in 2008. One strategy to avoid overleveraging is to limit your debt-to-income ratio. Experts recommend keeping it below 36%. This means your monthly debt payments should not exceed 36% of your gross monthly income. Another key is to have a substantial down payment. A 20% down payment is ideal because it reduces your loan amount and avoids private mortgage insurance, PMI. PMI can add hundreds of dollars to your monthly payment without benefiting you. Consider the location and market conditions before buying property. Research areas with strong job growth, good schools, and low crime rates. These factors can increase property values over time. Avoid buying in overheated markets where prices are already sky high. Diversify your real estate investments. Instead of putting all your money into one property, consider multiple properties in different locations. This spreads your risk and increases your chances of a good return. Keep an emergency fund specifically for real estate investments. This fund should cover unexpected repairs, vacancies, or market downturns. A good rule of thumb is to save 1–3% of the property value annually. 8. The Pension Mirage. What you need to know. Pensions can seem like a guaranteed income stream for retirement, but they come with risks. According to the Pension Rights Center, only about 13% of private sector workers have a traditional pension plan. That's a stark contrast to previous generations. One major risk is underfunded pensions. Some pension funds do not have enough money to pay promised benefits. The Pension Benefit Guaranty Corporation, PBGC, reported that as of 2020, the multi-employer pension plan system had a deficit of $65.2 billion. Understand your pension plan's funding status. Request the latest funding notice from your plan administrator. If the plan is underfunded, consider additional retirement savings to cover potential shortfalls. Diversify your retirement savings. Don't rely solely on your pension. Contribute to other retirement accounts like 401ks, IRAs, and Roth IRAs. This diversification can provide a more secure financial future. Know the rules for pension payouts. Some plans offer lump sum payments, while others provide monthly benefits. Understand the tax implications and choose the option that best suits your financial goals. Plan for inflation. Pensions often provide fixed payments that do not keep up with inflation. This means your purchasing power decreases over time. Consider investments that offer growth potential to counteract inflation. 9. Quick fix riches. The allure of get-rich-quick schemes. Get-rich-quick schemes promise fast wealth with little effort, but they're often scams. According to the Federal Trade Commission, FTC, Americans lost over $1.48 billion to investment scams in 2020 alone. Be skeptical of high returns with low risk. Legitimate investments typically involve some risk. If someone promises guaranteed high returns, it's likely a scam. The old adage applies: if it sounds too good to be true, it probably is. Research thoroughly before investing. Look up the company and the individuals involved. Check for any regulatory actions or legal issues. The Securities and Exchange Commission, SEC, provides resources for checking the legitimacy of investments. Avoid pressure tactics. Scammers often use urgency to push you into quick decisions. Take your time to evaluate any investment opportunity. Legitimate investments will still be there tomorrow. Learn from reputable sources. Books like The Intelligent Investor by Benjamin Graham offer sound investment advice. Graham said, "The individual investor should act consistently as an investor and not as a speculator. Seek advice from a trusted financial advisor. An advisor can help you navigate investment opportunities and avoid scams. Look for someone with a fiduciary duty to ensure they act in your best interest." In summary, avoiding these common wealth traps in your 40s involves smart strategies and staying informed. By being cautious with real estate leverage, understanding pension risks, and steering clear of get-rich-quick schemes, you can build a secure financial future. Remember, slow and steady wins the race in wealth building.